Most real estate investors are watching interest rates, inflation, or housing starts. But the problem is they're missing on the single most important indicator of long term multifamily success. And that is, where are renters actually moving to and from? Today, we're unpacking what the latest migration data is telling us and why the Carolinas are leading the charge, and what it all means for real estate investors looking to grow their real estate portfolio. John, it's great to be here with you.
Great to be here, Mark. I was just thinking, a lot of our listeners may be first-time investors, so we built an incredible resource. Actually, for maybe you're like a very seasoned investor, so this will be a valuable resource, just the same for those folks as well. But fulloutinvesting.com, we have a video you can watch that walks you through our unique approach to multifamily investing, but also just gives you all the nuts and bolts you need to know to be a more informed investor going forward. We have a sample deal as well as a preview of an upcoming deal that we're working on. So go to fulloutinvesting.com to learn more. But Mark, I'm excited to be here today, talking about renter migration, right? And, especially today, like what we're talking about is what's really happened in the past year and really over the past few years post pandemic. But I think we're going to see even a further acceleration in some of these trends, just with some of the uncertainty we're feeling in the economy, right? A lot of these places that renters are moving to are lower cost of living. So
Mhm.
if we move into a recession over the next few years, people are going to be looking for more affordable places to live. So this is valuable information every investor is going to want to know.
Yeah. And so where renters are moving to, I think that's really important. As a real estate investor, you want to move to where more clients are moving to. It's just like any business, right? You want to go into a market where there's increasing amount of clients, not decreasing, right? You might as well have the stream flowing at your back than against you. And so this is super valuable to understand. If you're going to put a dollar in the real estate market, you want to put it to where the ball is going. What is it? Wayne Gretzky says, "Skate to where the puck is, not where it is right now, but where it's going." I'm a
Where it's
Canadian, I
going.
should know
That's
this.
right.
We
Yeah,
skate to where the puck is going, not to where it is right now.
that's right.
And when I was playing hockey, John, I always knew that you got to find the open ice. You got to find the open ice, and so you got to find those blind spots that nobody is at, but where the puck is actually moving to. And so that's exactly like real estate investing. You want to be able to put a dollar in the market or invest in a market that is up and coming. So it's already improving. So we're not gambling here in regard to something happening 5, 10 years down the road. We're seeing the trends that is happening already. So the data is telling us it's already going in the right swing. And so whenever you invest in a market, you want to invest in a market as it's starting to rise. You don't want to catch it on the tail end. You don't want to catch it right at the bottom, because you want to verify that that area that you're purchasing in is in fact right. It is the right spot, because you can look right across North America and pick a market and put a dollar there, and you might as well make sure it's in an up and coming market versus a declining market, or like, I hope so, because it's in my backyard. And that's the beauty of this real estate investment firm, John, is that we could pick anywhere in North America, and we're picking these markets because that's what the data is telling us.
That's right. Yeah, it's such a critical factor. I mean, to your point, you want to go where the customers are and where the customers are going to be. And so understanding these migration trends is very, very important. And so, a little bit of history I think is important here. So post pandemic, we sort of felt this move. A couple of things happened in the United States. One, every state reacted differently. So we didn't have a sort of overall federal policy. There was an initial 45-day pause. But then beyond that, the federal said, look, we're going to leave it to the states. So, for example, I lived in Georgia, and the governor of Georgia, basically, I would say it was probably medium. In other words, they were encouraging mask wearing. Obviously, a lot of corporations, the grocery store chains, and places like that, restaurants were asking people to wear it. So they didn't restrict, but they sort of left it open to the individual and to the businesses to make those decisions. But if you look at states like California, New York, New Jersey, and what's interesting is I'm almost giving you the answer to the test, but the biggest out migration cities and states, I should say, were those states that had the strictest lockdown. Now, what's also interesting is those states also have some of the highest cost per living. And so all these factors combined, and then you add to that the rise in remote work. And all of a sudden people started saying, wait, why am I in San Francisco paying, thousands and thousands in rent when I can live in Charleston, South Carolina, or I can move to Arizona or Las Vegas or wherever. And so that great reshuffle started to occur. And really, it boiled down to those higher cost areas, high regulation states were the ones that saw the biggest out migration and where we saw the in migration. So we'll go state by state. So these are the biggest losers in a sense in terms of population. So California, New York, Illinois, New Jersey, and Massachusetts. Now, once again, high cost of living areas. Illinois may be one outlier there. Chicago is an expensive city, but around Illinois, there's some affordability. But all of those states had very strict lockdowns and, in general, strict business regulation. Because as people started to move, businesses started to say, well, gosh, we want to be where the talent is and where the population is growing. And so southern states, the Sun Belt states, have generally been more business friendly because historically all the business was in the West Coast and the Northeast. So if you're, the governor of Georgia and you say, hey, I want to grow my business bases down here, let me cut taxes, let me build out incentives. And so I would say Rivian was a really good example in Georgia specifically, where they cut an incredible deal. And Rivian now manufactures the car in the state of Georgia. Great boon for the Georgia economy. And we're talking about a tech business, that kind of is, just kind of like headline grabbing and it's attention grabbing and it attracts even more talent. So inbound states, we'll go from the top. Texas, in the last 12 months, have had 85,000 net population growth. Florida, typically growing about 3.5% a year. They lose about 1% a year to outmigration, so net about 2.5%. And then the Carolinas, North Carolina and South Carolina. In fact, South Carolina is a smaller state, so it is technically the fastest growing just in terms of percentage growth of population, with cities like Charleston and Greenville grabbing the most share of that new population. And then Tennessee would be another example. Now, Georgia's right in there as well, just below Tennessee. But Nashville has become kind of a hot spot. Obviously, if you know anything about Nashville, there's like a huge music culture there, arts, a lot of celebrities are moving there. And so once again, that's headline grabbing. And then that starts to say, hey, I want to be in where the action is, right? So it's where we really focus our investment decision making is in those states that we know we're seeing the biggest population growth. So for us, that's Florida, the Carolinas, Georgia, and we keep an eye on Tennessee. I will say, you also have to be mindful of supply. And Nashville's an example where their supply got a little out of hand. So we want to see how that plays out over the next year or so before we dive in too aggressively. But this is where people are moving, right? And, interestingly enough, Mark, the Carolinas, as I said, are leading the way. So we can dive in a little bit to the Carolinas, markets that we love.
Yeah, John, I noticed that a lot of the states where they're moving from, they're cold, very cold.
Yeah, yeah, yeah.
California is maybe the
The
exception, but I
exception.
mean, exceptionally high taxes there. But the high growth areas, they're warm, and so that was actually a big thing we saw during COVID is that health and spending money and time and focus on one's health, it became a lot more important when
That's right.
people realize, at this the virus could, that could, affect our health, and it did for a lot of people. So that's another play. You got taxes, you got affordability, you got landlord friendly when it comes down to investors investing in these markets as well. So we're going to jump in, but it's really interesting to see the way if you look at a heat map on fulloutinvesting.com, there's actually a slide in that deal deck that shows migration patterns. And there's like orange dots of where people are moving from in the states where they're moving from, and then blue where they're moving to. And it's very clear the migration patterns that people are moving to. And, U-Haul is another, they release a report every year. And it's actually the Carolinas are right up there in their top 10 this year as well. So John, looking forward to diving in, getting into the reasons why, Carolinas is one of the top spots to move.
Well, you nailed it with the heat, and the sun, right? And it's so fascinating. I'm 44, and how many times, the rules seem to change, right? And so I was growing up, it was like always wear sunblock, don't even go outside without, SPF 50 on or whatever. And now we're starting to learn that that pendulum maybe swung too far in the wrong direction, right? And that a little bit of sun is okay, and it's good to get that vitamin D. And it's like moderation, right? You don't want to sit out there for 10 hours,
Are
6
are you a
days a week.
sunscreen guy, John, or you just
Um,
no sunscreen? Are you kinda or
so
just
what I would say is this. So, like, if I'm going to the pool for the afternoon for like an hour or two with the kids on a Saturday, I don't put sunblock
yeah,
on. If I'm going to
yeah,
be at the lake all day and outdoors all
yeah,
day, usually after about 30 minutes, then I apply. But I'm mindful of it. I don't overdo it. And, I'm working all the time. So it's not that I'm outdoors all the
yeah.
time. But yeah, I'm generally, if it's an hour or two, no sunblock.
Yeah.
Yeah.
So, John, I learned my lessons. I have a quarter Italian, quarter Maltese, and half Irish.
Yeah.
So, the Italian and Maltese in me, it's like generally I've been fine not to burn.
Yeah.
Grew up,
Yeah.
there was a pool there I was always outside and I would tan. I was like, I don't burn, I tan.
Yeah.
Well, a few times I learned my lesson down here. I'd go to the beach and I'd be out there all day. It's like I don't need sunscreen, and then you get burned. And
Yeah.
so
Yeah.
I'm more swung into the pendulum has swung a little bit further. I think I'm in alignment with you. If I'm going to the beach all day, I learned my lesson. Get
Yeah.
some on before
Yeah.
I go, and I'll still get a tan on, but I won't burn the same way. So,
Yeah.
it's it yeah it,
Well, what they say, I mean, not to go too far down this rabbit hole, but 20 minutes a day of direct sunlight on your face is almost like a prescription. It's good for
vitamin
you,
D.
right?
Yeah.
So when I go for a walk, obviously I'm not putting anything on my face. Like I'm almost like wanting to, have the sun kind of in my face for a little bit when I'm walking kind of
Well,
thing.
they say that
But
like when you wake up in the morning, go for a walk, like that helps with your circadian rhythm.
that's
So
right.
it actually helps you sleep better. And then when you're actually if you go for a walk in the evening and as the sun's going down, that apparently is really good for you as well.
That's
So
right. It lets your body know, "Hey, it's time to wind down."
time for
That's
bed.
exactly
Yeah.
right. No,
Yeah.
but, the Carolinas, they're leading the way now. The first, factor is affordability. So, rent income ratios are just healthier. We've used examples in the past, but in New York City, it's like 70%, rent to income ratio. I know you mentioned Toronto is very similar.
60.
Um,
Yeah.
yeah, 60. So when we're targeting deals, say in Charleston, we're often at 27, 28, 30% rent income ratio. And that's after we've renovated the units. In fact, we won't buy a deal if it's over 35% because we know that's putting too much pressure on affordability. These markets are also very affordable for retirees, workforce renters, and families looking for an opportunity to stretch their dollar. In fact, what's really been a big boon for the Carolinas is there's sort of a term we say here, we call them halfbacks. What happens is somebody from New York or New Jersey or Massachusetts, they go down to Florida for the sun, but then they realize it's a little too hot and humid. So they kind of end up halfway back, which is the Carolinas. So Wilmington, Charleston, Charlotte, Raleigh have seen a lot of that retiree growth. You also add to the fact that North Carolina has incredible universities. You've got Duke, UNC, some of the top universities in the nation. And so a lot of kids end up loving it there and they stay. So that's another, driving factor because the grandparents want to be close to their kids and, potential grandparent or grandkids coming on their way. So Georgetown, South Carolina, where we're buying a deal as we speak. When you listen to this, we may have already closed, but in this moment, as we're recording this, we're raising capital for it. It's a huge retiree market, and one of the reasons we really love that deal. You also generally see, really vibrant downtowns, lower crime, outdoor recreation, that warmer climate we just talked about. So that lifestyle appeal is very strong. So, younger families looking, maybe remote work's a possibility. But by the way, I mean, Charleston has an incredible economy. Charlotte is a huge banking town, Raleigh technology. So there's a lot of reasons and jobs there already. But if you have that remote work and you get that flexibility, that's another thing. I just kind of touched on this, but Durham, that research triangle area. So a lot of science and technology. Greenville, manufacturing, a lot of logistics. The Carolinas and Georgia have done a great job also attracting auto manufacturers. I've already mentioned Rivian, but BMW has manufacturing in South Carolina, Volvo as well. In fact, the Volvo manufacturing facility is about 20 minutes from two of our Charleston assets. Another reason we love those deals. So those jobs are just kind of feeding that population growth, which is in turn bringing more businesses in. So a lot of corporate relocations to the Sun Belt over the last 5 to 7 years that are continuing to drive that growth.
Yeah, that's huge. And it's only going to get more and more popular, especially with the whole like made in America, with tariffs. I speak with a lot of business entrepreneurs down here. and they're repositioning their how they're operating their business, especially if there's a lot of relying on other countries because there's just a lot of unknown right now. So, I think that that's only going to grow. The other thing that John, that I'm really big on landlord friendly spots. We want to make sure landlord friendly, and this is coming from myself. Like I'm originally from Ontario. We run a real estate brokerage up there, just north of Toronto, and I mean it can take 12 to 18 months to evict a non-paying tenant.
Yeah.
Down here it's landlord friendly. Like if there's a non-paying tenant, we can evict and go through that process within like 1 to 2 months. He's simple. And it's just part of the process down here. If there's we'll say a resident that is not good for the community, they're causing challenges, they're constantly delinquent on their rental payments, we don't need to renew. Whereas, in some of these landlord, we'll say non-friendly locations, so like Ontario would be one up in Canada, and then you have like New York and California. It's like some of these areas is very challenging as a landlord. So it means that you have the stream is coming against you. You're swimming against the stream. Whereas down here in the Carolinas, I mean, it's in your favor. And so that is a significant thing, especially John, with our approach, the value add approach. We come in, we add a lot of value to start. We go in, we add amenities, we totally revamp the exterior, and then we start to do the value add approach, and we start to raise rents. This approach would not work very well in landlord non-friendly locations.
Yeah, that's right. And I think, one thing just worth noting is one of our values at Faris Capital and Faris Residence is a genuine love of people. So we actually had an example just from last week that I'll share. But, a married couple, they've been in one of our buildings for over 4 years, always paid on time, but the husband lost his job. But guess what? They came to us. They said, look, we've got this setback. He's actually got his third interview next week for this new opportunity. Is there something we can do here? And so we created a payment plan. We work with that individual. So it's not like, oh, you miss one payment, you're out the door. It's more about, are you communicative? Are you a good resident?
Yeah.
Can we work with you? So we always do keep that in mind. I just think that's worth pausing on just for a quick second there. All that to say, though, is this is really what's interesting about what we're talking about here, Mark. And I think this really kind of speaks to why we love, the Sun Belt, specifically the Carolina markets, Florida, and Georgia, but I'm going to isolate the Carolinas right here. So this is from apartments.com. So they, are tracking all this data, right? So people are looking, they're searching for homes, but they have the IP address of that individual. So they can see where that person's searching from. And so 65% of the people searching for the Raleigh Durham area are out of market. So they're not in Raleigh Durham. They're searching for rental units in that market. Charleston, it's 62.3%. And then Greenville and Greensboro, North Carolina, Greenville, South Carolina, it's about 55%. So the majority of people looking for a rental property in these markets are from outside the area. So it just goes to show the kind of attention. So that's like a leading indicator, right? Because, they're not there yet, but they're contemplating that move. And so if you took the total inventory of apartments, over 62% in Charleston are out of market. So it just shows that continued population growth will keep heading in that positive direction. And so what does this mean for you as an investor, right? It's like rental behavior. It's that leading indicator I just mentioned. So we know leasing activity is coming behind that as these people relocate and move. If they're searching now, in other words, they're moving soon. And looking at some of these secondary markets like Charleston, Greenville, Greensboro that offer value without the oversaturation that I mentioned is like specifically in Nashville earlier. That's another huge thing. So more upside, better pricing, and less competition, which in our world means better deals. And so Georgetown, Charleston, Noonan, Georgia market we're looking at right now, right outside of Metro Atlanta. It's actually in Metro Atlanta, but right outside of Atlanta are some great examples of those types of markets. So, the question then becomes, how are we acting on this data? Well, once again, these are markets we're already targeting. We're already invested in these markets. Our deals in Largo, Florida, Charleston, and we're targeting Atlanta and some of these other areas we touched on. We choose the markets with the right fundamentals and the people that help support that growth, right? So it just goes back to, we've seen some great deals. We're kind of on a national distribution list for a lot of these brokers. So I'm seeing deals in all over the country. But it just goes back to, they may be good deals, but do they to have the fundamentals and those leading indicators that would help us ensure that going forward, we know we're going to have the population of renters.
Hmm.
So our strategy is to buy while these markets are still accessible before everybody else starts diving in, right? Because unfortunately, for a lot of investors, what's happens is the operators are a couple of years too late, right? So they show up when it's already popular and booming. So we're acting on this information today to get ahead so that we're exiting these deals when it becomes oversaturated or, a lot of buyers start coming into the marketplace. So, just bottom line key insights here. Migration isn't a fluke. It's the clearest signal on where to invest. The Carolinas, Georgia, Florida, Texas are markets that have just incredible fundamentals for multifamily investing. And for us, it's all about just where's the renter behavior, where's that focus on affordability, and how do we position ourselves for long term resident retention. So that's our strategy and how we're acting on this information.
Yeah, well said, John. And just to recap, you want to skate to where the puck is going, not to where it is right now.
That's
And
right.
that's how we invest in real estate. And if you do that moving forward, you're going to bode very well. And that's where you get the friends and family saying, "Oh, that guy was a genius doing that." But the reality was, I mean, you were just smart enough to follow the data. The data is there and it's clear. The business plan for this to be able to capitalize is very clear as well. And that's our approach that we're doing right now. So skate to where the puck is going, not to where it is. Thanks for listening, guys. If you enjoyed the show, please subscribe and share to the channel and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.